2, 1.
Welcome to Made for More Living.
One small step for man.
With Johnny Jennings.
Kick the tires and light the fires, Big Daddy.
The fastest and most exciting hour of news, events, and real estate in Northern California.
And this is a fact that was proved.
Powered by EXP Realty. Online at madeformoreliving.com.
Does everybody know what time it is?
Get ready. Here we go.
Growing up, I always thought I would work for somebody. Like I went to high school, then I went to college, and I just figured I would end up working for somebody. But now
you do work for somebody. She's called your wife.
She's called my wife. She's called Valerie Jennings, my ex-girlfriend, my baby mama, and the love of my life. But I ended up, pivoting into becoming self-employed and, getting into real estate. But it's just funny how college, what you think is going to happen in college ends up taking a different twist.
Sure, absolutely.
Did you go to college, Matt?
I went to college and I got my degree in communication media arts, which is what I do.
Okay.
But
You're one of the few. Most people don't.
It's true, but my job didn't require the degree. So I got this job and I've worked my way up 24 years without the necessity of a degree. But my degree has also helped me get my master's in teaching, which hopefully one day I'll be able to do, but who knows? But you're right. I did go to college, spent a good amount of money, and didn't necessarily need it at the moment.
Yeah.
So
yeah, totally get that. And then on the show today,
did you graduate with a degree?
I did.
What was your degree?
I majored in history, minored in political science.
Okay, so those are applicable in many areas.
If you want to teach.
Right.
If you want to teach.
Sure, in a financial, practical way, no. Yes, it didn't work out that way.
In critical thinking, it helped. That's the biggest thing. But would I go back? Would I pay all that money? I probably wouldn't.
And where did you go to school?
I went to the Harvard of the West Coast.
Stanford?
Bakersfield. Cal State Bakersfield.
Well, there you go.
Yeah, so that's where I went. But on the show today, we have Miss Lindsay Boris with American Pacific Mortgage. She's an absolute gem, and she works incredibly hard. You have, 2 young kids?
I do. 3 and 4 years old.
3 and 4, okay. And you went to college as well.
I did. Yeah, I went in a very different direction, ending up in mortgage from where I got my degree. But I went to San Diego State, and my
gosh, everybody dreams about going to San Diego State. Is it all that it's cracked up to be? You're surfing every day. You're on the beach.
It was absolutely
class is being held
that it is
at sunset on the ocean.
I lived in an off-campus apartment, but right on campus that was on this cliff that overlooked down part of San Diego, and I rode my beach cruiser to campus every day.
Wow.
And spent all my extra time at the beach, and it was as magical as people.
Were your parents fitting the bill for this?
I stayed in Sacramento where I grew up and went to...
You're from Sacramento.
I am from Sacramento. Okay. I stayed here and got my undergraduate and did my AA.
Okay.
And had a little bit of money set aside for my grandparents in a 529. Nice. And that paid for my last 2 years. So I just got my undergrad done here, went down to San Diego, spent 2 years, and got my degree.
That's awesome.
After you what'd you get your degree in?
My degree is in medical and cultural anthropology, and so it was very research based. And when after I graduated and came back to Sacramento, I was working at UC Davis at a stem cell research lab.
Oh, nice!
And it was very cool.
Yeah. You got to really use your degree.
Yes, I was doing the work in the lab. And thought that it was everything that I wanted it to be. And the people I worked with were great. The place that I was at was wonderful. Mm-hmm. But it didn't really fit my family life. I didn't have the balance. I was in the stage of my life where I was getting married and wanted to start a family and didn't know that those two things fit together. Mm-hmm. And I had a family member that worked in mortgage and had an opportunity for me, and I took the leap of faith and ended up in mortgage and started working my way up, and then eventually switched over to the sales side, and have never looked back.
Never looked back. You have tons of experience. So, I mean, if people are watching the recording or hearing this story, like how much experience could Lindsay really have? Approximately how many loans would you say you've done?
Oh my goodness.
Because that would be the equivalent of like how many homes I've sold is like how I would benchmark experience rather than age. Because you can be in the industry 40 years and sell 40 homes, or you can be in the industry 5 years, and sell hundreds of homes. And so, like for you, how many
Yeah.
loans would you say you've done?
So far this year, our team has done 30 million.
What?
In volume. So
Wow.
Yeah.
what that equates to in units, we probably well over 2,500
Loans.
loans.
A lot. Yeah.
I'm sure that if I went back, that's a statistic I'm going to have to look up now and average it out. I would say that it's a pretty big number, and it's helped diversify the experience that I've had. Just
Yeah, so you've helped 2,500 families get into a home or buy a home, right? So when we have Lindsay on the show, just so you know, she's not wet behind the ears. She's been doing this a long time, has a lot of experience. And so you were talking about how you anthropologist, what was it?
medical and cultural anthropology.
Medical and cultural.
Which is what? What is that? What does that mean?
So what I was doing in college, my degree was primarily research based. So I was doing medical research, and with an emphasis on culture and humans and how those two things played into each other. So that's how I ended up working at the
I can tell she's
research
trying
lab.
to dumb it down for us. Matt.
Right.
Yeah, she's
wanna
trying to
go-
make it simple.
Yeah.
I didn't want to go too deep
How
into
can I
it.
explain it in
But
Johnny
essentially,
But-
you got into this business, and now you're almost not necessarily self-employed, but you're co-running the business, and that gives you a lot of empathy with a lot of people who are also running businesses, because there are so many people, myself included, who do not want to, shall we say, overpay Uncle Sam in taxes, but that makes it harder to qualify for like other types of loans.
Can we pause for just a second and
Yeah.
explain a little bit more about what you're talking about?
Yeah. So what we're talking about is, let's say you own a business, you're maybe it's just you, maybe it's you in a small company, or and what most people try to do. Let me back up just half a step further. So if you are not self-employed, you get your paycheck every week, every 2 weeks, every month, whatever it is, and out of that, depending on what you're claiming, right, your taxes are automatically deducted.
Right.
And sometimes people like to claim a little bit more, so then that way they get a return at the end of the year rather than have to owe money at the end of the
Right.
year. But taxes, every paycheck are automatically like a little piece is coming out to pay the state and the federal government. Well, when you are self-employed or you have a small business, you don't have to pay those. Like every time the money comes in, you have to budget for
Right.
the taxes. And what's different between self-employed versus a W-2 is, with the W-2, you get the taxes taken off the top, and you're left with whatever's remaining.
Right.
As a self-employed, you get to spend that money in marketing and human resources and fuel and transportation, all these other qualifying expenses, and then you pay taxes on what's left over. So what most people do who are self-employed or have a business is they want to invest in their business as much as possible and get that taxable income down to as low as possible.
Sure.
So you're showing no profit, little profit, negative profit, but then that makes it harder for you to qualify for a loan, because the bank is going to go, well, you didn't make any money. How are you going to qualify for a mortgage?
Right. Okay.
And so that sets the table a little bit for the conversation that we're having, where it's like Lindsay is a pro in helping self-employed people qualify for home loans. Isn't that right?
Yeah. So just like you're saying, Johnny, that we see that a lot of people, even if they're making a ton of money through their business, will write off the majority of it, and sometimes even have an overall negative net income. And they're paying themselves throughout the year,
Yeah.
and they're making money, but what's shown on paper is minimal or a negative amount, and makes it impossible really to qualify using your tax returns with a standard mortgage.
Yeah, and so just so we're clear, so you're like, how does it go negative and them stay in business? There's deductions you can take. Certain investments allow you to depreciate assets over a period of time. So if you have enough of these assets, you can actually show a negative income, even though on paper, even though the business is profitable.
Right.
And so from Lindsay's perspective, she's looking to see, are they actually generating like income? Are they profitable?
Yeah, how much income is coming to this individual? So when they're in a situation like that where their net income is low or negative, there are alternative ways. One of the ways that we can circumnavigate that and get people qualified to show a more true reflection of the income that they're making on a regular basis is with a bank statement loan. And we're looking at 12 or 24 months of their average deposits into their business account. So, for example, we had a client that on paper, between his 2-year tax returns.
What do they usually look at then?
What do you mean?
What
Qualifying?
does a bank, how do they usually get qualified? If it's not the bank statements, what is
We're typically looking at their most recent 2 years filed tax returns.
2 years filed tax returns is what they're usually looking at.
Correct.
And again, like you said, if they're self-employed, then that's going to be really low because of all of their write-offs.
Yes.
Yep.
And you're saying your method is what?
So say on their tax returns, they file very little income even though the business is doing well, and they average to $5,000 a month between their 2 years taxes. It's not really enough to qualify. A lot of times these people are making good money and they're looking to purchase relatively expensive homes.
Yeah.
So we can look at your most recent 12 or 24 months bank statements and average your deposits. And we have had, very recently, we had a client that he went from averaging $10,000 a month based on his taxes to over $80,000 a month. And that's what we were able to use as his qualifying income because he had $80,000 to $100,000 every month in business deposits. Revenue. And so then he was able to qualify for really whatever he wanted and opened up his possibilities. And the qualifying on it is not terribly different, 10 to 20% down, depending on your credit score. And the process going through is no more complicated than a standard loan if we were using the tax returns. But
the difference between Lindsay and the JJ Mack team and other lenders is a lot of lenders will not do the bank statement loan. Like
Why won't they do that?
It's more work.
Is that what it is?
It's a specialty product, and there's, like Johnny said, they're a little bit more work, but they also it's just not a product that everyone offers.
So like think of and correct me if I'm wrong. This is maybe not the perfect analogy, but Dave Ramsey's always talking about because he's a big advocate of not having debt. Not having any consumer debt, so you don't have a credit card, and so you don't have a credit score. If his perspective is, I'm winning, you're winning if you don't have a credit score, let alone a bad credit score, a credit score at all. And so what he's an advocate for is, he calls it manual underwriting, and that's essentially what Lindsay's doing with these businesses. Is They're going in and manually underwriting. Like forget what the FICO score says, forget what the tax returns say. What is the actual financial picture for this person, and what can they actually comfortably approve? Because that's the other thing I really appreciate about you and JJ and the whole team is it's not how much are they approved for. What they focus is on what's a comfortable payment for the person,
right?
Like long term. Because we're all about the not what if interest rates go down, not what if this person's elected, but even if interest rates go up or down, even if this person's elected, the person's going to be safe and comfortable with that payment for years to come.
Yes, absolutely.
Yeah.
We just had a client that came to us thinking that they wanted a bank statement, or an alternative document loan. Turned out he made enough money on his taxes for the price that he wanted to be at, because for him, the amount that he qualified for wasn't quite as important as staying within a monthly payment budget that felt best.
Got it.
So we weighed the option between those two and don't need to go with a bank statement option because it made sense for him, but we gave him those options so that if he did decide to put less money down or go to a higher purchase price, he had that option.
Yep.
We can look at it from two different avenues.
And so if you're listening and you're like, hey, this sounds like something that I might be looking for, this might be a solution to my problem, just go ahead and give us a call or shoot us a text at 530-GET-MORE. If you shoot us a text, just send text loan, and we'll get you over to the JJ Mack team so that way they can look at your finances. It's free. It doesn't cost anything. It's a quick 2-minute conversation. They don't need a whole bunch of information from you. It's just to see what programs you qualify for. So just call or text 530-GET-MORE, and we'll get you that information. And when we come back, we will be talking about their buy before you sell program. So are you wanting to maybe buy your next home before you sell your current home? We're going to walk you through step by step exactly how Lindsay's team helps you with that.
So are you curious what kind of offers you could get on your home? Then reach out to the best in our area. That's Johnny Jennings and the Tom Daves team with Made for More Realty, powered by EXP. There's a reason, guys, why they have more 5-star Google reviews than everyone else in our area, why they sell homes 27% faster at an average of 3% higher selling price. Find out about their Fix It Before You List It program. Even if you don't have the time and the money to do those repairs, they're going to help you get that done so you can get your home on the market and sold as fast as possible. That's Johnny Jennings and the Tom Daves team with Made for More Realty, powered by EXP.
This is Made for More Living with Johnny Jennings, powered by EXP Realty. Online at madeformoreliving.com.
It is competitive out there in the market right now. I don't know if you've been experiencing it all, Matt, or if you've heard stories, but people are looking to buy their next home, but they keep getting beat off because many people are wanting to sell their current home as well.
Yeah.
And they're like, man, but they're not. But the sellers of those homes are not willing to accept what's called a contingent offer, contingent on that home selling. So people are just getting frustrated, and oftentimes, in order to overcome that frustration and just win the house, they are actually bidding more than they would otherwise to win that next home. And so what we have done is
Is there a better way?
But there is a better way. There is a better way. And so that's why we've partnered with American Pacific Mortgage, specifically the JJ Mack team. And today we have Lindsay with us, who heads up that team.
Good morning.
Hi. And so what we're going to do is we're going to walk you through exactly how you don't have to get beat out on those types of situations. So if you're currently living in a home and you want to buy another home, whether you're wanting to buy a home out of state, even in Texas, we won't discriminate against the people moving to Texas, or if you want to stay local in the Sacramento region, there's a way to do that. And so we call it the Buy Before You Sell program, but there's a ton of different sub-programs within that, right, Lindsay?
Yeah, we have multiple options for drawing the equity out of your current house if you have a property that would otherwise be contingent to use some of the proceeds from your sale to put down towards the new house. We have more than one way that we can draw some of that equity and get you that money up front so that you don't have to write a contingent offer.
So, for example, let's say there's someone living in Sacramento and they got a new job out of state. Maybe they want to move to Tennessee because they got a brand new job and they want to move the family right away because the job starts on Monday, right? And they have found a perfect home. You know, they did some home shopping. Oh my gosh, it's gorgeous. It's perfect. You know, let's go buy it. You know, there's a bunch of offers, but what do? We got to first sell our home here in Sacramento. So they're in this little pickle. What do we do? You know, we don't want to lose this home that we really want that has property and everything, you know, but you provide an option for them. Mm-hmm. There's a way.
Yeah. And what we see a lot of times in situations like that is that people have no intention on holding on to both houses.
Yeah.
But they have a timing issue. They need to bridge this gap between buying the new house and selling the current house, but still being competitive in the market so that they don't have to pay more for the house or get their offer beat out.
Or find a rental, you know? Okay, they sell their home and then, oh, great. Now, what do we do in the meantime before we find the home we want? Well, we're going to have to go spend some money on a rental or stay or move in with someone.
Mm-hmm. That's why a lot of people are using this Buy Before You Sell program because it saves them money in the long run. They're not having to pay for a short-term rental. They're not having to pay for an Airbnb. They're not having to overbid. So let's say the house is priced at $500,000, right? What we're seeing is that your typical contingent offer is having to come in 3 to 5% higher than everybody else who is not contingent. So to be competitive, you're coming in 3 to 5% higher, $500,000 purchase price. That's an extra $15,000 to $25,000 out of your pocket. That's a lot in rent. Yeah. That's a lot in moving expenses that you don't have to pay if you're able to use the Buy Before You Sell program with the JJ Mack team.
So how does this work? It just seems like it's an impossibility.
So we have two different options, a third as well. And these different programs allow you to either, if you have some of the funds up front yourself, we don't have to factor in the debt of your current property against you when it comes to qualifying. In those situations, if people can come up with a minimum down payment, which is usually pretty low, 5%, then we can just qualify you for the new house mortgage payment. If coming up with the money on your own is not an option, we also have a couple of ways to draw from that equity if you need a larger amount of money to pull from the house.
So essentially, you're just using the current home you're living in as collateral for the next home.
Got it.
And the question that I get asked all the time is, well, how am I going to qualify for next home? Like, how am I going to make 2 mortgage payments? Like, how does that work?
Yeah, so I suppose that is part of it, that depending on the timing of it. But I will say that most people have every intention on selling pretty quickly.
Yeah.
And where people can feel a little relief in that is that after you buy a house, you don't start making a mortgage payment right away. It's usually 1.5 to 2 months out before you make your first mortgage payment. That usually gives people enough time, we see, to not feel that pressure of making 2 mortgage payments for an extended period of time. But that will be part of it, is that depending on how long it takes to sell your current house, you are still liable for your first mortgage until you sell that property. It doesn't take the liability away from you, but it can allow you to qualify for the new property and move in before you have to sell that other house.
And so just to put this in perspective, like 60 days may sound like, oh my gosh, that's so fast. Like Lindsay and the JJ Mack team are closing homes in like 11 days, 14 days. Like you find the home and 2 weeks later it's yours.
That's so crazy fast. Isn't that incredible?
It is. It's super fast. And it's partly because they're not a broker. They're a direct lender. Like they have brokering options. And so that it's just their funding process is way, 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 way quicker than brokers out there. So
I mean, think about that. Your offer is accepted and you're saying as little as 11 days, you could have the keys to your home. You could be moving into your home in 11 days.
Yeah, and
That's crazy.
These are not like atypical loans. These are like FHA. I think we did a 10-day VA one, like quicker than cash, like in many instances. Just because you're cash doesn't mean doesn't mean you're going to be faster, or it's because you got to move. Some people are cash and they have to move money around.
Yeah,
right, and it can take some time to do that. So that's.
And then you said there was a couple of other options though as well, right? Tell us about
so
those.
we have a couple of options for drawing from the equity of your current house, and then we also have the other alternative option that if you're able to come up with a small amount of your own funds, we have a program that will allow you to not have to count the debt of both mortgages against you. We can eliminate the debt as part of your liability for the house that you're going to be departing, so that you can still qualify, but you can come up with a small amount of money. And what a lot of people, we have clients currently that are doing what's called a recast after they sell their house. So they have every intention on selling their current house.
Yeah.
They were able to come up with a minimum 5% down payment to buy this house. And then when they sell their current house, they'll have a couple $100,000 in the next 2 months. And you can do a one-time recast that will still based off the same interest rate, but it reduces your principal balance and proportionately decreases your payment to reflect that lower principal balance.
Let's say you bought the home 5% down, that same $500,000 home, that's $25,000 down, so you owe $475 on the loan. But then you sell your home, that's the new home in Tennessee. But then you sell your home here in Sacramento, you make an extra $100,000 off of it. Well, now you're down to, now you can recast and you can put that $100,000 down on the home that you're living in. So now your loan balance is
based off of a
$375.
What do you mean by recast?
So it's an alternative to a refinance. So it doesn't change your interest rate, it doesn't change your term, but it reduces your principal balance and also reduces your payment.
Gotcha.
Because you could make additional principal payments every month, and a lot of people do, towards their mortgage, but it's never going to change your payment. It's just going to change the length, how much more you owe and how much longer you have to pay for. But when you do the recast, it allows the home to be your loan to be reevaluated at a lower principal balance.
So it's lowering the monthly?
To lower your monthly.
Does it cost anything to do a recast?
It's a very small amount. It's a few $100s.
Okay.
So that it just to cover the processing of reevaluating that on the back end. But it's a very common process. It's easy, and it works great in a market where interest rates haven't come down say you purchased and the interest rates are still the same when you're ready to do your recast, because usually it's just a few months later, then you don't have to go through the process of refinancing, worry about taking a different interest rate, or pay for a refinance, and you can still take advantage of a lower payment. And then when the opportunity down the road, when interest rates comes up, you still have that possibility too.
You can still refinance, but that's another great thing. So what I absolutely adore about American Pacific Mortgage, specifically the JJ Mack team, is all of their different options. So they have like hard money, they have new construction, they have land, they have mobile home, they have bank statement loans. And then if that wasn't enough, they also allow you to be able to refinance within a period of time, like with your streamlined refinance program, right? So essentially what that does is you're able to refinance for free if the interest rates come down. So a lot of people are saying, hey, I just don't want to be stuck paying this.
That is a really great idea.
It saves you thousands of dollars, like
So
thousands.
explain that in a little bit more detail, what that offer is.
For our returning clients that we close their loans and then they come back to refinance, and for a lower interest rate, we cover their loan costs.
So basically, if someone is out there right now and they want to purchase a home, but they're nervous about the interest rates, like they feel like, well, if I get into this home, what if interest rates drop? Well, then I'm in trouble and there's nothing I can do. And my neighbor's going to have a lower interest rate than I am, but you provide an option.
Yeah.
So
I would say that's really appealing to most people, because they are taking a higher interest rate at the moment to get the house that they love, but they are very much hoping and anticipating for when the time comes that they can refinance. And so a lot
of people are waiting for that. They're like waiting. Well, I'm going to wait until the interest rates bottom out. I'm going to keep waiting, even though I need really to be in a home now.
And what's crazy is too, once interest rates go down, guess what's going to happen to home prices?
Sure.
They're going to go up, because it's just a balancing of affordability.
Yeah.
And so
That's
if you
smart,
you get in with interest rates now, then interest rates start dropping, your appreciation will go up, your equity will go up, and then you can just do the streamlined refi with Lindsay and JJ Mack over at American Pacific Mortgage. Saves you what, $3,000 to $5,000 depending
so it's a free refinance.
Yeah,
we cover the loan costs of the refinance for our returning clients, so that and in a lot of situations, if they need an appraisal, we'll give them a voucher to cover the cost of that too.
Is there a time period of where they need to be in, a window of when they can do that refinance?
It's usually 12 to 18 months after you purchase your house, but that program has kind of continuously been extended as rates have stayed higher for longer, because we want to give that benefit to our clients, especially our returning clients. We want to make sure that when they're ready to refinance and take advantage of the lower rates in the market, that they come back to us and we take care of them again.
Yeah, this isn't like a bait and switch program. Oh yeah, you can refinance in the next 3 hours for free, you know?
No, we want our return clients to come back and be happy, and that's part of the service that we like to provide to people, and have lifelong clients.
Absolutely. And so we've been talking about the buy before you sell program and the streamlined refinance. If either of those things interest you, please give us a call. Shoot us a text at 530-GET-MORE. That's 530-GET-MORE, and we will get you in contact with Lindsay, so that way they can provide you with these services. The call is quick. The call is free. It does not cost anything. It will not ding your credit. And this way you can at least start the process, do some pre-planning, and don't miss out on this incredible opportunity to buy before prices start going up again.
I think we can all agree that trust is a critically important thing when it comes to your finances, when it comes to those big transactions like selling or purchasing a home. And that's why we can't recommend anyone better than Johnny Jennings and the Tom Daves team with Made for More Realty. How do you know you can trust them? Well, just check out their 5-star Google reviews, more than anyone else in our area. The record shows that they sell homes 27% faster than anyone else in our area, and for 3% on average higher selling prices. So if you're looking for help in selling your home and you want someone that's going to do a professional job, someone you can trust, then reach out to our good friends Johnny Jennings and the Tom Daves team with Made for More Realty, powered by EXP. Just Google them. Made for More Realty today.
This is Made for More Living with Johnny Jennings, powered by eXp Realty. Online at madeformoreliving.com.
So, Matt, have you heard of that axiom where you can have things done fast, well, or cheap, but you got to pick two?
No, I've never heard that. So
You've
you can
never
only
heard
pick
it?
2 out of the 3.
Yeah.
So if you want something done fast and well, it's not going to be cheap.
Correct. Or if you want to do it yourself, it's going to take longer, but the quality might be high.
Right. And it'd definitely be a lot cheaper.
It'd be a lot
I'm doing
cheaper.
it myself,
Yeah,
but it's
but
going to take forever. If it will ever get done.
If it will ever get done.
like my backyard.
Your backyard. I was thinking like changing the oil, or those project cars. People are like, oh, I'm going to do it myself.
Yeah. My wife's really good at that.
Changing the oil?
Oh, yeah, absolutely. She's always changed the oil. I never knew how to do it until I got married, and she does it. She's great
So
at
she
it.
still does it?
Yeah.
Even
One time
though
I got home from work, and she's like down on the ground changing the car oil. I'm like,
Oh
yes,
my gosh.
I'm married well.
Lindsay, can you change oil?
I actually can.
Good for you.
I thankfully don't have to. I let that be something that my husband takes care of.
Right.
But before I was able to get a car when I was 16, my dad insisted that I knew how to change my own oil,
That's
change a
cool.
tire, check my fluids, all
Good
those
for
things.
you.
So
Wow.
it's been a little while. I'm probably a little rusty, but I could still do it.
That's awesome. Good for you.
Yeah. So, but the good news is, we were talking about fast, quick, fast, cheap, and well, right? The 3 different categories,
Right.
but you got to pick 2. The good news is with Lindsay and the JJ Mack team, they hit all 3. They're an exception to that rule. Speaking specifically when it comes to home loans, right? Because you guys close loans so fast, like lightning fast, faster than cash sometimes. We were talking about that in a previous segment, but can you explain a little bit why that's so important, why you guys have an emphasis on speed?
Yeah, it's become the edge in the market when competition is high. And if you maybe don't have an all cash offer or the highest bid sometimes to a seller, and we see it often, getting that loan closed as fast as possible is a huge selling point for a seller to accept a buyer's
because they want
offer.
the certainty.
Yeah.
Right.
And a big part of what we do for that is we get a lot of our clients fully underwritten before they're putting in offers so that they either don't have to write a loan contingency. It allows to close very quickly, but we have had plenty of situations. We have an incredible underwriting and processing back-end staff
Yeah.
that allows us to close in 10 to 14 days.
10 to 14 days. And so let's tell a quick story. I think there was a client that you were working with that was up against a cash offer, right? Can you share a little bit about how that played down with your guys' speed?
Yeah, that was the only thing that set them aside. They came up in price just a tiny bit. I think it was a $10,000 difference over an all cash offer on an almost $1 million property.
Oh yeah, that is tight.
So it wasn't the money wasn't a huge difference, but we said we can close in 13 days, and the seller said it'll take 10 to close cash. So if you can close your loan, we're willing to take the additional 10 grand and accept your offer over a cash offer. And we closed right on time, and they were able to get their house, and it was the reason the seller said that they got their offer accepted was that we could close it that fast. So.
Awesome. And so if you're feeling like you're getting beat out by cash offers, they should give you a call. They should reach out. Go ahead and give us a call. You can contact them at 530-GET-MORE. That's 530-GET-MORE, and we'll put you in contact with Lindsay and the JJ Mack team. So that way you can have a loan, an offer as good as cash. And but the other benefit too is people are probably thinking, man, I wouldn't be ready to move in 2 weeks. Whether you're moving out of an apartment or moving in your own home, well, don't worry. You don't have, just because you close on the home, that doesn't mean you have to move into it, right?
Yeah, absolutely. Once the house is yours and you have the keys, you can take your time. A lot of times the sellers just maybe need that money to purchase the next house.
Exactly.
They're moving, and that 2-week time frame is key for them to make their next move in their life. So as a buyer, your options are that you can once those keys are in your hand and it's yours, you can move at whatever pace feels comfortable for you.
And oftentimes sellers aren't willing to move that, like aren't ready or capable to move that quick. And so what we oftentimes do is negotiate either a paid or free rent back for whoever we're negotiating or whoever we are representing. So that way all parties have time to get in or out of the properties. So when I say rent back, that means it's just the seller is remaining in the property for a period of time before they move on to their next home.
Yep.
And so, anyways, you can close quick, good as cash, but that's not all. No, that's not all.
But there's more.
I've been reading Cat in the Hat a lot, like for
That's
Jack.
a good book.
I almost have that book memorized.
We have the
Oh, yeah.
whole Dr. Seuss collection. Some of them are better than others.
Yeah.
Yeah.
They're hard to read though sometimes.
What's
There's
the
some
one?
tongue twisters in there.
The orange one. That's not Hop on Pop. There's one where
Rocks and Socks or
Fox
something.
and
Fox
Socks.
and Socks. Yeah.
Fox and Socks
I do
and
not
Box
like
and
that
Box.
one. I don't like
Jack
it.
loves it.
Does he?
I practice it because I think maybe it helps me enunciate a little bit
There
better.
you go.
So I don't
Yeah.
have the
oh my gosh.
the country
I'm like,
mumble.
what?
But anyways, that's not all. Oh no, that's not all. It's the cat's jumping on the ball.
Yeah.
So, but that's not all. You guys also have a couple different loan programs. So if people are saying, "Hey, there's no way," because what are interest rates are somewhere at the time of this show in the high 6s, low 7s. So regardless of where interest rates are at, that is not important. Just imagine if you're getting quoted a 7% interest rate right now, imagine you can get an interest rate in the 6s or the 5s or maybe even in the 4s. Like if you're waiting for interest rates to come down, there's no need to wait any longer. We can get you a rent interest rate potentially down in the 4s. You might explain how that works, Lindsay.
Yeah, so it's a wonderful, effective strategy that we can use for any of our buyers to help alleviate some of the payment shock maybe of having those higher interest rates and give them some temporary relief until potentially interest rates are at a position where they could refinance into a fixed lower rate. And it's a temporary buy down. We have a 2-1 buy down, a 3-2-1 buy down. There's also a 1-0 buy down, which is just a 1-year buy down.
Oh, I didn't know that.
Yeah. And
so what that means, can you explain what that means in terms of buy down?
Yeah. So for the first year, your payment is either 1, 2, or 3% less than the rate that you are locked in at, depending on which of those, the 3-2-1, 2-1, or 1-0 program that you're using. And it subsidizes your payment to bring your payment down to reflect a payment at a 1, 2, or 3% lower rate than what you are locked in at.
So for 1 year, it could be up to 3% lower than what you're locked in at. But then the next year it changes, right?
Yes. So if you are doing in the situation of a 3-2-1 buy down, your first year's payment would be 3% less. Year 2, it's 2% less. Year 3, it's 1% less. And then by year 4, it would resume your locked rate. And for most people, that period of time, they've had the relief in their payment and the opportunity to refinance has presented itself so that they can lock into a lower
interest rate.
But feel the benefits of a lower payment in the meantime.
Yeah, and so it just really helps with affordability. It helps with that monthly. And again, so we're all about the not what if, but the even if. And what's great about this program that you offer is they have to qualify based on no buy downs, no credits, no nothing.
Correct.
Right? So when that time does come that they may be paying that whatever the current market rate is, if they have not refinanced at that point, they can qualify for it.
Yes,
So
that's a great point.
We're not giving people bad loans. We're not pushing people into home ownership or putting them in a situation where they may end up on the street or have to sell their home. We're making sure that you're able to afford it, but we're also able to provide you with this great benefit in the meantime.
Absolutely. And it can make a significant difference. We had a client recently that was able to do the 2-1 buy down. It was a purchase price in the $800,000 range. And the first year, their payment was almost $900 less
A month. Wow.
than if they hadn't had the buy down. And it can make a bigger impact than just permanently buying your interest rate down. And it's still a benefit, obviously, but in this situation, it gave them a huge decrease in their payment.
And then what's great is if you dovetail this 3-2-1 or this rate buy down program with your streamlined refinance, they can get an interest rate that's 2 to 3% lower than market rate. If interest rates do come down, they can now do your streamlined refinance program where they get to refinance permanently for free, right?
Yep.
Yeah.
And a lot of times people feel, I would say one of the few things people say is, well, what if I don't go the full term, 3 or 2 years? But in almost all circumstances, you can use any remaining funds if needed to go towards covering some of your refinance costs. For us, we cover those. So it's, but
does it go towards principal then, or what happens to that money?
It would depend. So it would depend on how soon you refinance and how much is left.
Okay.
But I would say most people do usually ride out that first year or so because it's such a relief in their payment. And it would depend on a little bit where the market goes.
That makes sense.
If rates haven't come down 2% below where you are locked at, you may not feel the pull to refinance.
There's no point
because it wouldn't be a better payment than you already have.
Yeah.
So most people do ride that out, but if there's any remaining amount left, that can always go towards covering like your if you were needed to have some taxes or insurance, like prepaid items.
It's like the impound account. So for those of you who are listening, and like, what's an impound account? Like, I don't want my car getting repossessed. Like, this isn't an impound lot. This is an account that's where like your taxes and your insurance and all that stuff lives. And so sometimes you may, if you've owned a home, you're like, why is my payment going up? Okay, well maybe taxes have been reassessed. Maybe your insurance has gone up, and so you need to reallocate funds for that impound account, right?
Yeah.
And so if you have money left over from this buy down program that Lindsay and the JJ Mack team offer, you can just put that into the impound account.
Yeah, you could potentially do that.
So there's no loss here in terms of dollars.
Yeah, and the funding for these comes usually from the seller of the home.
Yeah.
So it's really not necessarily any money lost by the buyer.
Yeah.
Which is great all around. They're getting this money, they're getting this subsidy covered that helps give them their relief in their payment as well. So.
And this is something that like your realtor should be negotiating for you. Like, we have specific strategies and techniques on how to negotiate it so that way the seller is open, and not only open but wants to pay for your rate buy down. And so if you're interested in learning about how that works, just give us a call. 530-GET-MORE. You can shoot us a text as well and just say house or loan if you're wanting to learn more about the loan side, but if you want the negotiation strategies, just 530-GET-MORE. We'd be happy to get you that information so that way you can get a lower interest rate and get into that home that you want. Any last comments, Lindsay? It's been an absolute joy having you on the show.
It's been wonderful chatting with you guys today. It's been a lot of fun. Thanks
don't
for
tell
having
JJ,
me.
but I think you're a better guest than JJ.
I won't tell him.
No, tell him.
Tell him.
That's the only way he's going to improve.
Yeah,
Okay, you
he
don't
needs to
improve
know.
unless you know the truth.
He needs to know,
Yeah.
Lindsay. All right, thanks again.
Thanks so much, guys.
So are you curious what kind of offers you could get on your home? Then reach out to the best in our area. That's Johnny Jennings and the Tom Daves team with Made for More Realty, powered by EXP. There's a reason, guys, why they have more 5-star Google reviews than everyone else in our area, why they sell homes 27% faster at an average of 3% higher selling price. Find out about their Fix It Before You List It program. Even if you don't have the time and the money to do those repairs, they're going to help you get that done so you can get your home on the market and sold as fast as possible. That's Johnny Jennings and the Tom Daves team with Made for More Realty, powered by EXP.
This is Made for More Living with Johnny Jennings, powered by EXP Realty. Online at madeformoreliving.com.
Matt, did you see this article that recently came out by Newsweek? It was talking about massive housing bubble is about to burst.
Oh my goodness.
So people are talking about this. They're talking about the cooling of the market. And but what I don't understand what they mean by bubble. Like when I think bubble, I think of like the 2007, 2008 bubble where prices came down like over 50%.
Right.
Are they talking about
Home values?
Home values came down. Are they talking about like a 50% cut? Are people now going to be able to go out who can't afford a home right now because they're $500,000 and go out and pick one up for $250? They're talking about that, or are they talking about, you know what? Maybe we won't see 3, 4, 7% appreciation year over year. And so,
so what do you think they're talking about?
I think it's a lot of fear mongering. Like they gotta, if it bleeds, it bleeds.
Right, exactly.
And so that is my take when I read something like this, because what people are not factoring in is why that first bubble happened in the first place.
And we're talking about 2007, 2008?
Yeah, 2007, 2008. By the way, that's like the only bubble in the history of like residential real estate in the United States. So it's not like it happens cyclically. It's not like it happens every 10 years. There's just correction. There might be some corrections, but not like a huge bubble bursting. And the reason why it happened was because bad loans were being written.
Yeah.
People were getting into situations that they could not afford. They were just saying how much money they made. The lenders were riding in it because there'd never been a housing crash before, so why would there be one now? And then eventually the problem got so systemic and so big that prices had been artificially inflated, and now people couldn't afford these loans anymore. Eventually the bill comes due. And so
they set up, seems like they set up safeguards and different policies to prevent that from happening again, correct?
Absolutely. They went they went from one end of the spectrum to the other, to where like now there's all these safeguards and stuff. Like it's a good thing. There were good things that were done. Maybe some things that were a little overdone. Maybe some people were penalized that maybe shouldn't have been penalized. Some industries or aspects of the real estate transaction. Like I'm thinking title companies. Like title companies used to be able to be more involved in a real estate agent's business, and now they're like completely hands off. They can't even pay for a coffee. If you meet for a business lunch or a coffee, they can't even pay for a coffee. And so it's pendulum. Anyways, the pendulum swung so far that now people are, compared to at least 2007, 2008, overqualified for these homes. And home prices have gone up significantly since then. So now not only are people not underwater on their homes, but they have tons of equity. So if prices do start adjusting, the vast majority of people can sell the home.
Right.
They're not underwater. Between them being able to qualify and between them having equity in the home, the likelihood of a housing bubble, this massive housing bubble bursting, is just
not realistic.
Not realistic at all. That being said, we are seeing a cooling in the market,
especially when it comes to California. California is, I think, when you say a very different real estate environment than the rest of the country.
Well, especially
to some degree,
especially in terms of pricing,
right,
and in terms of inventory. Like California, it's really hard to build.
Yeah,
and so there's all these people that need homes. There's all these people that may have. It's classic supply demand. So demand is so high, but they can't ease the supply because of all these restrictions on building. You got to save the snowy plover, but people can't have affordable housing.
Right.
So is that right? Is that wrong? I'm saying there's some balance that needs to be found there to help ease this this shortage of homes.
Okay.
So you bring up a good point. This exact article is actually talking about the South. Like it's not even talking about, like, they're painting it as like the U.S. housing market, but when you go in, they got me. I clicked on it, right. So they did their job. They're selling me now beer and homes.com and all these other things on the page, but they got me to click, and essentially it's just talking about the South. But nationally, there has been a slowing down in the market.
And what would be the bubble that's going on in the South that they're talking would be bursting? They're just saying. Is that just home prices?
Yeah.
Okay.
Yeah, they're just saying because people are not buying home. There's more people coming to the market now. So again, supply demand. This is real. I like to say all the time to clients, this is real estate, not rocket science. And so if supply is up and demand is down, prices will fall. If supply is tight, like limited, and demand is up, prices will increase. Doesn't matter what's happening to the interest rates. Doesn't matter like how many people are coming to the market. It's that supply-demand balance. Now, those other things may influence, how many people are coming to the market, how many people can afford the homes. It may have an impact on it, but at the end of the day, it's just balancing supply and demand. And so right now in the South, there's an overabundance of supply. And that's actually something that we're starting to see in our market right now. So, for example, I'm looking at the most recent stats, and if you look at homes that sold in 2024 versus 2023, and keep in mind, 2023 was like the lowest sales on record in like the last 30 years.
Oh, wow.
So you go back further than 30 years, there's less sales, but how much has like the Sacramento region grown?
Sure.
In the last
goodness,
30 years. So like it's a totally different market 30 years ago. But if you look at, so that being said, in 2023, in June of 2023, there were 2,949 sales in the Metro list, which is our MLS community. Okay. So a little shy below that. So 2,900. In June of this year, there's 2,700 homes that have sold. So roughly 200, 250 less homes have sold this year compared to last, and last year was the lowest on record. And so what that means is if there's fewer homes going on the market, then there's fewer sales, or if there's fewer sales taking place, then there's potentially that demand can start increasing because you're not thinking like the toilet paper analogy. Remember COVID? How
right.
All of a sudden there was a massive demand for toilet paper and you couldn't get any. But now, so what we're seeing now is there's plenty of toilet paper on the shelves, and so people are not in a frantic rush to go out and buy that. So now you're starting to see the prices come down a little bit.
Okay, so for those that are listening that are looking to buy a home or sell a home, what is your advice? What's your expertise that you're giving people from Made for More Realty?
So what we're seeing right now is, again, I always couch it with, I don't have a crystal ball. If I do, but it has tons of cracks in it, right? So I wouldn't trust the crystal ball. But what we're seeing is a cooling off of the market. So if you're thinking about selling a home and the numbers make sense to you, sell it now. If you're thinking about buying a home, then maybe just wait a little bit and see what happens and see if you can get a better deal in the fall. But if you're thinking about selling a home, now is probably a better time to sell than waiting, if the numbers make sense to you. If you're going to be in the home for the next 3 to 5 years, don't freak out, don't panic, stay there. But if you're thinking, hey, you know what, I was really planning on selling this summer, should I still do it? I would say yes. Because what we've seen is a 400% increase in price reductions since January. So that means if you're a seller, the likelihood of you having a price adjustment on your home has gone up by 400%.
But if they want to get the most money possible and in a short amount of time, they want to sell their home quick, they don't want it sitting on the market, what do they do?
So what's the first? So obviously call 530-GET-MORE. You can reach out to us. We'll do some pre-planning with you and give you some strategies on how to get that property ready. And then that way you can make the best decision for you. Sell it now or sell it later. But first step, call 530-GET-MORE. You'll get in contact with us and we can help begin that pre-planning process.
530-GET-MORE or madeformorerealty.com.
Absolutely.
Right? Madeformorerealty.com. You can just Google it. Johnny Jennings, madeformorerealty.com or 530-GET-MORE.
You got it.